Good evening, ladies and gentlemen, boys and girls. My name is Andrew Kalita from Inspire Realty, and welcome to tonight's episode of Inspire Inform, episode number 13. A very interesting topic to speak to you about again tonight. And tonight I'm excited to announce that there will be a spreadsheet in tonight's session, one of my favorite tools for really wrapping my head around the different topics and concepts. And really, it's always my go-to method in order to be able to, I guess, offer certainty and assurity around the decisions that I'm making in my own property investment journey, as well as it's a tool that I go back to time and time again to assist clients to do exactly the same thing. And that's essentially building a better future together. And that's what we hope to share on tonight's Inspire and Inform. And the topic we're going to be talking about tonight is a concept or a phrase that I've heard time and time again throughout all of the education, all the different books that I've read and the podcasts that I've listened to. And that's the concept of timing the market versus time in the market. And it really, before I get into it, I really wanted to share that obviously the information I'm going to be sharing with you tonight is for educational purposes only. It doesn't constitute advice. We really have no idea about any of your particular circumstances, and every bit of advice that we do give here at Inspire Realty is really catered towards your individual circumstances. It's not something that no matter who walks in the door, they get the same solution, because ultimately everybody's needs and goals and aspirations and situation is completely different. And that's really the value that we provide here at Inspire Realty. So the most common question that we get on a daily basis here at Inspire is now a good time to invest in property? And this morning I was inspired. I was listening to a podcast, and one of the commentators on the podcast had a really unique take on this and shared some analysis and some logic to back up their view. And their view was that it doesn't matter quite as much about the two biggest things that people concern themselves. People concern themselves when it comes to building an investment property portfolio with the wrong things. They're concerned, is now the right time to buy? And let's go out and hunt the best deal that I possibly can. I need to grab me a bargain. I'm going to go look for a deceased estate, and I'm going to offer them 20% less than what they're asking for. I'm going to crunch out a deal. And whilst you obviously make your money when it comes to property investment when you go into the market, when you buy, it's an interesting concept I wanted to share with you as to probably is now the right time, what's going on in the economy, what's going over with America, China, is the property market going to collapse? Is COVID going to be the end of property investment as we know? What's going on in the market? Whilst it's a very important concern, as well as trying to buy a property that's below market value is also an interesting concept, and we'll delve a little bit deeper into that, and it's very important. It's probably not the most important thing. And I'm going to share with you, I guess, what I feel personally is the most important thing when it comes to property. And it's selecting the right asset to purchase, combined with spending enough time in the market, having that long-term view, that long-term mindset that is really going to pay dividends above and beyond anything you can gain with perfectly timing the property market, buying exactly at the bottom and riding the wave all the way up to the top, as well as that 5-10% that you might be able to save by buying a property that is below market value. And I'm going to give you some justification of why I believe that to be such an important variable. And of course, always here at Inspire and Inform, our objective is to educate you and provide you with the tools to make better property investment decisions along your journey. But of course, everyone's situation is different. And if you'd like to have a chat about your own personal circumstances, or just want an opinion, or want to sit down and have a full-on strategy session with us to plan out and map out what your next 5, 10, 15, 20 years is going to look like, and how you're going to get from where you are today towards that longer term objective, we're very happy to help. You can reach out to us by either commenting on the post. Always appreciate a like so we can reach out to some more people and continue to grow our audience here to provide value. Or you can visit us at www.inspirerealty.com, and one of our strategists will be more than happy to reach out to you and arrange a convenient time to have a free 45-minute consultation. So moving forward, when you're considering when the right time is to buy an investment property, there's obviously a lot of factors at play. You know, do you have access to the right finance? Are you in a relationship and you have two incomes and you can easily access finance, or you're at one income, or whatever your situation is? Your ability to hold over the long term / cash flow considerations. Because here at Inspire, we're very much of the mindset of a buy and hold over the long-term strategy. And what we're going to discover tonight is that it's really capital growth is what you take out of the market. That's where you build the wealth for your future, to give you the choices and allow you to live the lifestyle that you desire once you decide it's time to finish working. But it's really cash flow, which we've covered in other sessions, and I'm sure we'll cover again in the future, that gives you that opportunity to hold on to your investments, whether it be one investment or 50 investments, over the long term, to allow the capital growth to happen. And we're going to work out tonight why it's so important for you to be able to hold on to it over the long term. Obviously, tax considerations, one topic that we likely dig into deeper in the future is around the tax deductions, negative gearing, depreciation, and how that has an impact over the after-tax holding costs of your property, because there's two different concepts there. There's the pre-tax and post-tax. Planning considerations, what stage of your portfolio journey that you're in, whether you're in an acquisition or a growth phase where you're building up the baseline of assets that's going to deliver that lifestyle for you in the long term, or whether you're in a more of a consolidation or paying down debt phase of your portfolio growth, moving closer towards retirement and starting to reap some of the benefits of your hard work over the years. How close are you to retirement? Again, that concept of property being a long-term investment comes into play. And to give you, an example, if someone's left it a little bit late, or more than a little bit, and they come and speak to me and say, hey, look, I'm age 60, I want to go out and buy a property, I'm planning to retire in 5 years, the likely conversation, barring a variety of number of other factors, is going to be, potentially property is not the right investment vehicle for you at this stage of your life. And there are a lot of variables around that. Of course, what's going on in the economy, what are the demographics, the PI formula, population, infrastructure, employment, how does it relate to the Australian economy? How does it relate to the particular state? How does it relate to the particular suburb? What are the macro and micro factors? All those things are important, as well as this concept of getting a great deal lying below intrinsic value. So what does intrinsic value mean? It means fair market value. Are you buying at below fair market value, the investment property? And it's interesting. The point I'm really trying to drive home tonight is that asset selection, or buying a high quality investment grade asset with owner-occupier appeal and scarcity and all these lovely things that we look at when we're making a recommendation of a property here at Inspire for one of our investors is fantastic. But the interesting thing is, people want the best of both worlds. They want to buy an asset that's in high demand, and lots of people are going to compete for it if they were to ever sell to buy that property from you. But they're also expecting at the front end for that property to, for example, the typical example you see is, oh, I'm looking for a deceased estate or a mortgagee in possession. I want to get a great deal and a great bargain with no other bidders. And then all of a sudden, as soon as I buy that property, I want there to be 20 people queuing up to buy from it. It's almost a contradiction of mindset. Now, I'm not saying here that we go out and we pay in excess of what the property is actually worth. Those deals and those, diamond properties or perfect properties, or unicorn properties is probably a better term, are very few and far between. And the likelihood is you're not going to realize it when you do see it. It's only in hindsight that you realize that a particular property may have been a unicorn. And a lot of people that I speak that have been investing for a reasonable period of time love to share those war stories about that particular property. Oh, I wish I bought that. It doubled in 5 years, or all those sorts of things. I'm sure you've all heard those stories before yourself. So the point I'm going to emphasize in tonight's presentation is, okay, let's look at how it all plays out over the long term. We're going to look at an example of, and we're going to take an example of if we paid 10% below market value for a property versus if we paid 10% over market value for a property. And we're going to play out those scenarios over the long term. And we're going to demonstrate to you tonight why asset selection should be your number one concern rather than market timing, rather than getting a great deal or a bargain. Because ultimately, remember, the underlying concept we're trying to stress here is capital growth is what you take out of the market. That's where the wealth is. That's where the magic is, and compounding over time. It's not the deal when you go in. Yes, it's important, but it's not the most important thing. So what are the most important things? Having a long-term mindset combined with the ability to hold that property over the long term. Property is a different asset class than shares, which tend to have a lot of volatility. Even reviewing my own share portfolio over the last few days, I've had 4, 5, 6% swings in my share portfolio in a single day. I guess the data and the statistic, depending on which market that you're talking about, potentially the property market over this whole COVID, pandemic, has had maybe a 5 to 10% swing, again, depending which market you're looking at and which property type, over the whole pandemic. So where property really stands out, it doesn't have a lot of volatility, and we've covered that in the past and happy to cover that again in the future. So it's almost like a slow and steady growth over the long term. Yes, there's periods of ups and downs, but if we look at the past 30, 40, 50, 60 years of data when it comes to property in Australia particularly, it's been a very solid asset class, providing that you can hold on to it over the long term. And again, capital growth is where we make our money in the property market. Yes, there's plenty of other ways to make property in the market. You can buy, you can renovate, you can sell, you can build duplexes and split boxes. There's lots of different ways to make money in the property market. But the question I really encourage you and strongly encourage you to do is or to ask yourself is, are you qualified to take up all these different types of opportunities? If you were looking at buying a house, knocking it down, splitting it up and building a duplex, do you have the skill sets and also the time to invest in it? Because that, in my mindset, is very much active income. So that's why for the average person, the average Australian, which is the people that we love to help, hardworking, everyday Australian people, our mindset and the strategy that we help them to implement is a buy and hold over the long term. And that's why we're so strong and try and foster this long-term mindset when it comes to property investment, because historically that's the most proven path and least risk path towards achieving most people's goals over a lifetime and allowing them to finish work and to be able to live the lifestyle that they deserve. So without further ado, let's dig in and look at a couple of examples, and I'll share with you my lovely spreadsheet that I built for you all tonight. So let me just switch over to this view so you can see it maybe a little bit clearer. So as you know, I like our numbers, and I've come up with a couple of scenarios, and I've built this out over a 20-year period that you can see here. So at the moment, and all these I've built as variables, so we can look at a couple of what-ifs analysis. So how does it actually impact? But the one I've got up here for you at the moment is assuming we're going to buy a property worth $500,000. We're going to buy it at 90% of its property value. So it's worth $500,000, but we're going to pay $450,000. Over the 20 years, we're going to assume a capital growth rate of 5%. Now, we know that this doesn't happen every year on year. If we look back over any 20-year period in Australia property market history, but over the long term, Australian property market has actually grown at between around about 7 or just, I think it's 7.14% on average. Now we're going to factor in some costs here. We're going to assume we're getting a rental yield of 3%. We're going to be paying interest only at 4% over the whole period. Just for simplicity's sake, I haven't converted these numbers into principal and interest. And there's a lot of expenses when it comes to holding a property, whether we're talking apartments or houses, might be strata costs, property management costs, vacancy rates, all those sorts of things, property maintenance, depending on the age of the property that you're purchasing. But generally, a good rule of thumb is factoring in around about 2% of the property's purchase price for associated costs each year. It's a good way to sort of back of a napkin do a calculation to demonstrate a point. And we're also going to compensate for inflation, so meaning our rent goes up each year and also our expenses. So how does that look like? So property we buy for $500,000. We get a loan amount of $450,000. We're also going to borrow the full amount just for this example. So we're not going to worry about deposits and LMIs and all those sorts of things to demonstrate this out for you. Our gross rent at a 3% yield is $15,000 per annum. Our gross interest we're paying at a 4% interest rate is $18,000 per annum. Got about $10,000 of expenses, which is 2% of $500,000, meaning we've got a negative cash flow. It cost us $13,000 out of our pocket to hold on to this property for our first year. And then we go along and we extrapolate out the numbers growing at 5%. And what you can see is because of the rent growing with inflation, whereas our interest is staying static, our cost to hold starts to diminish as we go along. So that's our scenario here. But the other important factor to consider when looking at these numbers is I've assumed a capital growth rate of 5%. Now, why have I assumed that? Well, in this scenario, I'm again going back to, well, in order to get a property that's below intrinsic value or below fair market value, I'm not saying it's impossible, but the likelihood is you're going to have to, or potentially have to go to a location that's a little bit less desirable, not as much in demand. You're going to have to pick your market timing perfect. You're going to have to do, everything's going to have to converge in order for you to achieve this goal. So at a 5% return, let's have a look at what the gross numbers look at over a 20-year period. So our property value in 20 years' time growing at 5% that we bought for $500,000 is worth 1.2, less our purchase price of $450,000, because remember we bought this at 10% below market value. So our net capital It's worth $813,000 because that's how much money we've made in capital growth over this 20-year period. Our cash flow, so over 20 years, it's cost us $225,000 in order to hold on to this property to get this $813,000. So our net position after 20 years is $587,000. And I'm just going to write this in here, 587,827. Okay. So let's look at another scenario here. So let's pretend we actually got the timing of the market wrong. Let's pretend we fell in love with the investment property that we found and we ended up paying 10% over market value for that property. So we paid 110% of the purchase price. It's only worth $500,000, but we borrow $550,000 in this scenario to buy it, to pay our 10% over. But because we've selected our asset carefully, we've got the right combination of population, infrastructure, employment, it's in the desirable street within the neighborhood. It's very much has owner-occupier appeal. And we can be, because we're willing to overpay in this scenario, we can be a little bit more selective as to which asset that we choose. And we choose the best asset that we possibly can. And remember, the discount or the deal is very short-lived. It's in the first, you get the benefit or that capital or that equity in the first year. Whereas remember, as long-term investors, we're looking at 5, 10, 15, 20-year time frame. So if we picked a better asset, so let's say we picked at something that grew around about the average rate that we've seen over the last 20 years in the Australian property market. It's very general. It grew at 7% per annum. Now, remember, we've paid 10% over market price. We bought at the wrong time. We fell in love. We've gone crazy. We paid more than what it's worth for a good asset. If that's grown at 7% over the last 20 years, at the same calculation, our property is now worth 1.8, less our purchase price of $550 because we paid $50,000 too much, a net capital 1.2. It's cost us $305,000 in negative cash flow to hold on to this property. Remember, that's pre-tax, but that's for a later discussion. Our net position is $952,000 against our $587,000. So the point that I'm really trying to drive home with you all tonight, and the key takeaway, is that asset selection is the number one priority, assuming we've got the cash flow side and the ability to hold on to that property over the long term covered. Once that's determined, asset selection is the number one priority. And yes, it would be an even better situation if we paid 90%. We'd end up with 1.132. So yes, we'll be better off, but it's not the most important consideration. That asset selection with the combination of population, infrastructure, employment, a gentrifying suburb, something that appeals to owner-occupiers, and all the other different variables to make sure we buy a premium investment-grade asset is a key determining factor over the long term, 5, 10, 15, 20 years, that's going to determine our success. Not the 10% that we discount from the listing price up on real estate or domain that we go out and hunt for if we have to sacrifice on the quality of asset that we purchase. So yes, we'd love to get the best deal that we can, but the first thing to sacrifice, I'd rather pay more for a good asset than less under market value for a crappy asset. So that's what I wanted to really drive home with you. The other key takeaway that I really see when I look at this spreadsheet again now with you is that basically property is a very much a forgiving asset, providing you're a buy and hold long-term mindset. So even if you get it wrong, providing you can afford to hold on to it for long enough to allow for the capital growth to happen, you'll be okay. So the message out of that is don't get too caught up in trying to find that unicorn that is the best possible asset at 10% below market value, and until you find that, you're not going to invest. Because if you wait that 2 or 3 years, and I haven't built the spreadsheet this way, the equation will be drastically different. So the point is to take action, to find the best asset that you possibly can. And if you're not confident to do that for yourself, or, these numbers are really spinning around in your head, I know I love my numbers, feel free to reach out to us at Inspire. I'm happy to go through this scenario. Maybe you've got a different variation or permutation or something that you're a little bit confused of or didn't understand with what I shared tonight. Very happy to go through that with you, spend some time with you, completely obligation free. Or even if you wanted to sit down and delve a little bit deeper and put in place a strategic portfolio plan that's going to take you from where you're at to where you want to be over the long term, happy to help. Just comment on the post. Again, would love a like so we can reach more people and continue to add value. Or visit us at www.inspirerealty.com. We have a lot of other great resources that we put up on our website to try and add value, make you better property investors. But ultimately what it's really about is seeing you to reach your longer term goals. So very happy to help. And I think that's about all for me tonight. So I'm going to say good night and thank you very much for listening, and we'll see you all next week. Bye for now.